In high school, I was lucky. I had a class that taught me all I needed to know about taxes and how to actually file them. After I graduated, my sister went to the same school. It turned out their graduation requirements had changed a little bit. They could start taking that class online. Flash forward, after college is over, my sister starts her first job and she says, "Hey brother, you mind taking a look at my taxes for me?" And I look at her a little bit confused and she says, "Yeah, don't really know how these work." Turns out most people in the US are probably more like my sister with their high school education than like me. And so today we will be going over the fundamentals of taxes, namely how you file your taxes after you get all your paychecks and documents for the year. My name is Nathan Mohan. I used to advise companies on how to allocate their finances, but during my time, I quickly learned that people were better at allocating company finances versus managing their own personal finances. With that being said, let's get into it. Now, there are three fundamental building blocks to filing your taxes. Building block number one is your filing status. Building block number two is deductions, and building block number three is credits. Today, we're only going to be talking about federal income taxes, and we're going to be referencing everything based on the 2025 tax year. Now, the fundamentals of this video will likely apply to subsequent years, so you should feel free to watch, even if you're watching this video a couple years down the road. But with that being said, a couple of the specific examples that I use may be a little bit different. Let's start off first with filing status. If you already know what this means, feel free to use the timeline to skip ahead to whatever content you actually want to get to know about. There are 5 different primary filing statuses within the US tax system as of 2025. They are single, head of household, married filing jointly, married filing separately, and qualifying surviving spouse. These filing statuses really do determine almost everything about how you'll file your taxes. They change the tax brackets that you're in, and they often change the amount that you pay based on deductions and credits that you can file for and get, which again, we'll cover later in the video. The filing status that you take actually isn't as flexible as you might imagine. Let's start off with the first filing status, for example, single. The single filing status is made for those who are, as it says, single. So if you're legally separated or divorced, you would still likely fall under this bucket. The other thing to know about this filing status, it means you don't have any dependents. A dependent is usually a relative that depends on you for 50% of their living expenses or more. The two most common types of dependents are qualifying children, and what a qualifying child is a child that depends on you for more than 50% of their living expenses. They are usually under the age of 19, or that age bracket could be extended all the way up till 24 if they're still in school. They live with you 50% of the year or more, with some exceptions to this rule. Most notably, if you're the parent of a student, then if your student is in a dorm, technically this residency rule doesn't apply. And the last rule is the child may not be filing taxes or be required to file taxes and cannot use the tax status married filing jointly. So what this means is if your child is married and they aren't required to file taxes but still use married filing jointly, that's a-okay. If your child is married and they don't use married filing jointly and they use married filing separately, also a-okay if you claim them as a dependent. However, the one thing they cannot do is be married and be required to file taxes and use the filing denomination or designation married filing joint. Now, the other type of dependent that you will see is a qualifying relative. A qualifying relative is basically someone who has lived in your house for 50% of the year, and again, you pay 50% of their expenses, or alternatively, if they do not live in your house, you still cover 50% of their living expenses and they're related to you. Common relations that you might see here are nieces, nephews, grandparents, parents, step-sibling, sibling. There's a larger list on the IRS website, which will be linked in the description below. But the last piece here, which makes a qualifying relative more difficult to have, is the qualifying relative must make under a specific gross income limit, with certain exceptions for non-taxable income, a la Social Security. That limit as of 2025 is $5,200. Now, dependents are a very important concept for the next filing status that we'll talk about, which is head of household. To qualify for the head of household filing status, you need to make sure that you're single and usually have a qualifying dependent. But the requirements are a little bit more strict than just a standard qualifying dependent. That dependent must have lived with you for over 50% of the year, with obviously the exceptions for things like temporary leaves from your residence, so illness or for school being excluded. The one caveat to this is if your qualifying dependent is a parent that you are taking care of, in that case, they do not necessarily have to live with you for you to claim head of household. Now, as head of household, you also have to make sure that you are taking the expenses for over 50% of the home or the household. And so that's usually met if you fall under this status, but just something to keep in mind. Head of household has strictly better tax rates than single. And so if you're able to claim head of household and not single, I would do it in almost any instance. Now, if you're married, you have two options. The first one is married filing jointly, and the second one is married filing separately. You can basically decide with your spouse which one you want to use. Married filing jointly is the best outcome for the vast majority of filers. There are a couple of instances where married filing separately makes sense. Those commonly include if you have a lot of medical bills, and the other one being if you are maybe going towards separation, then it may make sense to separate your finances a little bit early. Married filing jointly tends to offer more favorable tax brackets in general if the two spouses make unequal amounts of income. The reason being, if you combine the income then and you look at the tax brackets, they are structured in such a way that you will receive much more favorable tax rates. However, if the two spouses make pretty close to equivalent amounts of money, then they actually would be better off filing as two single individuals and not actually getting married, which is a fun little quirk of our tax system. As the most clear example of this phenomenon, imagine that both you and your spouse are making roughly $500,000 each. If you both filed together under married filing jointly, you would be owing about $289,000 in taxes. If you did that same thing and filed as single, then you would owe $282,000 in taxes. Now, the last tax filing status that you'll see is qualifying surviving spouse. I'm really hopeful that none of you will have to use this designation in the near future. It is a designation specifically made for if your spouse passes away in the past 2 tax years, then you can continue to use married filing jointly. Now, to be a qualifying surviving spouse, you must have a dependent child. It is a strictly better filing structure versus any of the other filing structures that you'll see made for moments of hardship. Keep in mind, for filing statuses, tax brackets are really the biggest differences between them. And like I said, we'll talk about some of the more nuances later in the video. But you can see here that via the tax brackets, probably the most beneficial status is qualifying surviving spouse, followed by head of household for individuals. Married filing jointly, as I mentioned, if you and your spouse make unequal amounts of money, it's actually quite beneficial. It's not as beneficial if you make similar amounts. And if you have any questions about tax brackets and how they work, you can find a video that I did on this earlier, explaining this in probably a more simple, easy to understand way. Feel free to click on that. Now that we're done talking about filing statuses, let's move on to how people actually reduce their tax bill. They do it through 2 ways, which is deduction and credits. Let's start off first with deductions. Deductions are expenses that you can use to offset the income that you make such that your taxable income goes down. Now, what does that mean? Say I made $100,000 last year and say I have $20,000 in deductions. That means the IRS will only tax me on $80,000 because my income is reduced by the amount of deductions that I have. The amount of work that goes into your taxes is actually probably most determined by the types of deductions that you take. There are 2 different ways to take deductions. The first way is called a standard deduction. Now, a standard deduction is a deduction that's allowable for every single taxpayer, and it basically allows you to offset your income with a standard amount. That amount changes year to year and depends on your filing status, but it's a super easy way for you to basically just reduce your tax bill, and it's very easy to use. For the year 2025, you guys can see the standard deductions here on a table on screen. Now, the other way to look at deductions is by itemizing. Itemizing deductions basically looks at several different expenses that you've had during the year and sees whether those expenses can be put towards offsetting your tax bill or offsetting your income. But to be very clear, you can usually only take the standard deduction or itemize your deduction. There are a couple of notable exceptions to this, which we'll talk about in a minute, but you have to make sure that if you are itemizing your deductions, they actually outweigh your standard deduction. Most tax softwares actually now do this calculation for you, but to just give you a taste of some of the deductions you can itemize that might put you above the standard deduction limit, the most common deductions that you'll see are mortgage interest, state and local taxes end up usually being a deduction, medical bills, and any sort of donations to charity. However, there are a few special itemized deductions that you can take even if you are taking the standard deduction, and these are known as above the line deductions. These include HSAs, IRAs, 401ks, student loan, and alimony. In my own personal experience, I used to almost always take the standard deduction until I ended up buying a house and ended up being in a geography where my state taxes ended up being higher, and at that point itemizing my deductions made sense. But usually what you'll see is that over time, as you have more money, as you donate more to charity, as you pick up certain expenses that qualify, you are more and more likely to start itemizing your expenses. One note here, if you are under the filing status married, filing separately, you must either decide to both itemize your deductions or alternatively both take the standard deduction. So it is a little bit of a wrinkle with that specific filing status. The last piece to filing your taxes is credits. Credits work a little bit differently than deductions. Credits are basically one-for-one dollars that go into paying off your tax bill. Say for example, you have $1,000 in tax credits. That will reduce your tax bill by exactly $1,000. Credits actually also have a pretty unique function. There are certain credits that are called refundable credits, and if you get those credits, even if your tax bill is zero, you could receive a refund for the government. So say for example, you have $0 in taxes, but you have a refundable credit of $400, then you'll get that $400 back to your bank account. Similar to deductions, there's a lot of different credits, but they are a little bit more nuanced, I would say, even the simple ones versus what you see in deductions. And so we'll go over some of the common ones here. The first, probably most common credit that you'll see is the earned income tax credit. And the earned income tax credit is a credit that's given based on the amount of income you make and the number of dependents you have, and of course your filing status. Basically the way this works is up to a certain point, the more income you make, the more of a tax credit you receive. That plateaus, and then as you make more income beyond that plateau point, the credit that you receive goes down and trails off. And the way that curve looks very different for if you have dependents and of course depending on your filing status or you legally separated. Now note, you cannot claim usually the earned income tax credit if you're filing under married filing separate, unless you lived away from your spouse for 6 months or more, or alternatively you're legally separated and did not live together at the end of the year. Now the next credit that we'll talk about are education credits. There are 2 education credits that you can get, but you can only take one in any given tax year for a student or qualifying student. Those tax credits are the American Opportunity Tax Credit and the Lifetime Learning Credit. Similar to the Earned Income Tax Credit, you don't really have the ability to qualify for education credits if you are filing under the status married, filing separate. Now, these education tax credits are a little bit unique. They can also be claimed for your dependents, as in you claim them on behalf of your dependents to reduce your own tax bill because you're paying for their education. Now, we'll talk about the American Opportunity Tax Credit first. This is a tax credit that is worth up to $2,500 for qualifying expenses for a student. The student must be enrolled in a program that is recognized by the IRS, and this tax credit can be only taken for 4 years for any one given student. Now, you can take this tax credit if and only if you have income that is below $90,000 $100,000 if you're filing under a single tax status, or $180,000 if you are married filing jointly or qualifying surviving spouse. And if you make above this, the tax credit no longer applies. There is also a phase out, so you can only get the maximum credit if you are at $80,000 or under if you're in one of the unmarried filing statuses, and at $160,000 if you're married filing jointly or you are qualifying surviving spouse. Now, the lifetime learning credit is actually very similar to the American Opportunity Tax Credit. The only difference that you'll see is that it's not bound for just 4 years, and it's only worth up to $2,000. Unlike the $2,500 that you see with the American Opportunity Tax Credit. Now, one of the most common tax credits that you'll see is the child tax credit. And this is a tax credit that you can get for any qualifying children that are under the age of 18. This tax credit is usually about $2,200 per child, at least as of 2025. And it, as you'll see, is pretty generous with its income limits, with it being in 2025, again, about $200,000 for the unmarried filing statuses and $400,000 for married filing jointly and for qualifying surviving spouse. The last credit that you'll pretty commonly see is the Savers Credit. And the Savers Credit is one that allows you to get a credit for any sort of contribution to a retirement account. And that credit really differs based on your overall income and your filing status. And so I'll put that on the screen as well. All right. With that, y'all, realize this was a really dense video, but thanks y'all for watching. We'll likely come back with some more tax content as we're in the depths of almost going to be tax season, but talk to you then.